Hey traders, Nick here doing the homework in order to get ready for the week. Stick around to the end because I think all of it is important. I'm going to speak of catalysts, I'm going to speak of targets, and I think every bit is important. It's only 5 minutes. I promise I'll try to keep it in 5 minutes. Okay, so I'll start with the S&P, and it's going to represent the three major indices, the S&P, the Qs, the NASDAQ, and the Dow. So the target for the S&P, like we've been talking for weeks and weeks, once they broke out of 460, the technical target is in the middle of the 500s, 530 to 560, maybe even higher. That's what they're going without a miracle headline. This is a weekly chart. The pattern is called an inverse head and shoulders. The target is as big as this above here. So it is, if this was chart ABC, nobody would be asking any questions. So the bears need a miracle headline. The only thing that is stopping the S&P from exploding there in a week are the IWM. In my opinion, this basket of 2,000 stocks needs to break out of 205, 6. They can do that. That's like 3% from Friday's close. So if we have a burst this week in the small caps, and they do have some earnings that could cause that, the small caps will target 235, 240, which is probably a 20% rally, 17 to 20% rally. Imagine what happens to the S&P. Okay, so if I'm a bear, I need to have protection. What? I would buy a call in the SPY. I would buy a call spread in the SPY. I don't know what kind of bearish positions everyone has. I have a few credit call spreads. I don't need a lot of protection. I would have a couple of debit call spreads, shorter time frame, and that fixes me up. So what could be the catalyst for this week? We have a bunch of candidates. I think the highest profile one is the CPI. I don't want to debate whether Powell is done cutting or is done talking and is he going to cut or whatever. My thesis is that he's not going to cut in March. I was right about that. I don't think he's going to cut in May either. There's a good chance, nobody's saying it, that he doesn't cut at all this year unless the data changes drastically, because he's done his job perfectly according to the metrics. Okay. He didn't eliminate inflation, but he did stop the rise of inflation. So the CPI is not what we pay. It's just a measurement that shows that there's no runaway inflation. He did that job. He's not about to mess around with it. So anyway, the CPI comes out on Tuesday. It's likely to be a catalyst. Up or down, I have no idea what the number is going to be or the market's going to react to it. I would imagine if it's hot, they're going to drop. But they really haven't cared much. The bond market is listening, so watch the TLT. The bond market has been falling, which means rates are rising in the bond market, so they somewhat agree with me. You need a bounce in the TLT in order to keep the rhetoric alive. Like, the rate cuts are coming, you can't have the TLT falling when rate cuts are coming. If the TLT is falling, rate cuts are not coming because rates are rising. That's what happens. There's inverse relationship between the TLT price and the yields. That the rates rise as the TLT falls. That's a fact. So we need to watch the TLT as well. This is a pivotal week. I'm focusing on the reaction to the CPI. We do have the PPI and a few other bond auctions, I think Monday, and scattered other data. So they are just using headlines to rally. The headline comes out, they react one way or another, and then they rally anyway. Good news or bad news. So I don't think good news is bad news anymore for now. There is absolutely no fear or concerns in the market, period, end of story. I'll say it again, there is absolutely no fear. December 12th, there was absolutely no good news. December 13th, flip of a switch. That was the catalyst. Now they're just running for running. Rate hike, rate cuts, they don't care. There is zero fear. They will need a headline to remind them that there is fear. I don't know what it will be. I don't know when it will come out. I don't want to be fighting it. Now, what kind of trade setup would I have this week? This is a buy the dip market. I'll show you the visuals and I'll explain what I mean. This is the SPY, couple of months. There hasn't been a dip longer than $1.50, 1.5% over the 3 days in a long time. The biggest one was into January 5th when we bottomed. Since then, we've had rallies, small dips, and every rally yielded a higher high. So what? When you see a next couple of red days, don't be piling into puts. They're suckering you into buying puts so they can pay for their buried calls. So the market makers are losing on the calls they sold a long time ago by making the money off of people buying puts on dips. The next one that comes, don't say, oh, this is the big one. Expect them to bounce and make a higher high. So what? Which means if I'm short something and I get profits from this dip, I should act like that's it. I'm not going to get a penny more. Or if I'm short and I get relief from a dip, I should fix my problem, trade. Like if I bought puts or I have a call spread and this relief gets me out of trouble, I should act like I've been saying. So bulls are in charge, dips will be bought, therefore the bears need to look for a top which hasn't presented itself. The companies leading this charge are massive companies that have the power to yank the market by its ears to high noon. Wherever they want to take it, they can. We still have inflation and it's super high. It's just not rising anymore. And that was the CPI thing. High prices are here to stay. How will they affect consumer spending? We don't know. Consumer spending is 2/3 of the US economy. And when we stop spending, the economy will feel it, and then the GDP will change, etc., etc., etc. So be safe, and I'll see you. I'll send out a note tomorrow morning before the market opens.